In today's video, we are doing a deep dive into shipping business accounting, covering the complete business flow, end-to-end accounting treatment, real-world journal entries, financial statement impact, common errors, and the kind of interview questions that companies actually ask. Whether you are preparing for a job interview, working in finance, or just building your accounting foundation, stay with us because this video covers everything. In this section, we will go through all the key concepts of business understanding in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. The shipping industry is a cornerstone of global trade, transporting goods across oceans. Major players include Maersk and MSC, managing vast fleets to facilitate global commerce. In India, companies like Blue Ocean Shipping Services play crucial roles. This industry is capital-intensive, with high stakes in fuel and vessel maintenance, affecting profitability. Understanding this landscape is essential for grasping the financial dynamics that drive shipping companies. Shipping companies like Blue Ocean generate revenue through freight charges, charter services, and logistics solutions. They manage substantial costs, including fuel, crew salaries, and port fees. The ability to optimize routes and utilize economies of scale is critical for profitability. Understanding these revenue streams and cost drivers is essential for financial planning. For instance, a prolonged increase in fuel prices can significantly erode profit margins, requiring adept financial management. In a shipping company, the finance department manages accounting and budgeting, while operations oversees fleet logistics and route planning. Procurement handles fuel and supplies, and legal ensures compliance with maritime regulations. Each department plays a crucial role in financial accuracy and regulatory adherence. For example, operations must coordinate with finance to optimize shipping schedules, directly impacting cost management and profitability. The workflow in a shipping company starts with client order placement, followed by route planning to optimize logistics. The procurement team sources necessary supplies, while the operations team executes the shipping process. Finally, billing and accounting ensure financial records are accurate and compliant. This structured flow ensures that each department's efforts align with the company's financial goals, maintaining efficiency and profitability across the organization. Shipping companies interact with various stakeholders, including clients who demand efficient services, vendors supplying fuel and parts, and banks providing financial services. Government bodies regulate maritime activities, ensuring compliance with international standards. Each stakeholder influences accounting practices, from revenue recognition to cost management. For instance, delayed payments from clients can affect cash flow, necessitating careful financial planning and stakeholder communication. Shipping companies face unique accounting challenges, such as managing a complex working capital cycle and handling intricate contract terms. Regulatory compliance is stringent, with international laws governing maritime operations. These factors demand precise accounting practices to ensure financial accuracy and compliance. For example, fluctuations in exchange rates can impact revenues, requiring dynamic financial strategies to mitigate risks and maintain profitability. Accounting in the shipping industry differs from generic companies due to its focus on voyage accounting and international tax regulations. The movement of goods across borders involves complex tax jurisdictions, impacting financial reporting and compliance. Voyage accounting tracks costs and revenues per journey, providing insights into operational efficiency. Understanding these unique aspects is crucial for accurate financial management in shipping, ensuring legal compliance and strategic financial planning. In shipping, the finance department typically handles accounting entries, triggered by transactions like fuel purchases or customer payments. These entries are crucial for maintaining accurate financial records. The process involves recording, classifying, and summarizing financial data, ensuring compliance with regulatory standards. Understanding the timing and triggers for these entries helps in effective financial management, allowing the company to make informed strategic decisions. Today, we'll explore each step involved in accounting for a shipping company like Blue Ocean Shipping Services. From receiving orders to financial reconciliation, understanding these processes in detail will help ensure accuracy and efficiency. Let's dive into how each department plays a role, the documents they handle, and the accounting implications for each step of the journey. The first steps in shipping accounting are crucial, involving order placement and approval. This ensures that services are precisely defined and authorized, preventing misunderstandings or errors. Sales teams at Blue Ocean Shipping Services handle these tasks, using systems like CRM and ERP to manage customer orders. Approval triggers accounting entries, setting the stage for accurate financial tracking. Missteps here can lead to incorrect billing or service delays, impacting customer satisfaction and company revenue. Once orders are approved, contracts are drafted, and advance payments are managed. Contracts ensure legal clarity, handled by the legal department, while finance manages advance payments, securing cash flow. Systems like contract management software and financial accounting systems are used. This step is critical to mitigate risks and ensure financial stability. Any errors in contract terms or payment processing can lead to disputes or financial strain, highlighting the need for meticulous attention. Executing the shipping service requires coordination and precise documentation. Operations teams manage logistics, ensuring timely and efficient service. Documentation like bills of lading confirms cargo details and delivery terms. This step triggers work-in-progress accounting entries reflecting ongoing service costs. Accurate documentation is crucial to avoid disputes and ensure proper billing. Errors can lead to incorrect charges or legal issues, emphasizing the importance of robust system integration and meticulous tracking. After services are rendered, ensuring completion and preparing accurate invoices is critical. Operations teams confirm delivery, using systems to update service statuses. Invoicing, handled by the finance department, uses this data to generate precise bills. Accuracy here ensures client satisfaction and timely payments. Missteps can result in delayed revenue or customer disputes. This phase aligns operational success with financial documentation, reflecting the service's true economic impact. The final steps include receiving payments and financial reconciliation. Finance departments handle payment processing, ensuring funds are accurately recorded in accounting systems. Reconciliation aligns financial records with bank statements, confirming all transactions are accounted for. This ensures financial integrity and helps identify any discrepancies or fraud. Errors or delays here can lead to financial reporting issues or cash flow problems, highlighting the need for rigorous checks and balances. This comprehensive flow diagram illustrates the sequential steps of the shipping business accounting process at Blue Ocean Shipping Services. Each phase, from order to reconciliation, is strategically aligned to ensure smooth operations and accurate financial reporting. Understanding this flow helps streamline operations and identify potential bottlenecks, ensuring that each department is synchronized, avoiding costly delays or errors, and maintaining high service standards. In this section, we will go through all the key concepts of accounting concepts in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Revenue recognition determines when a company records its income. In the shipping industry, this is particularly important due to complex contracts that may span long durations and involve multiple performance obligations. The industry follows International Financial Reporting Standards 15, or Indian Accounting Standard 115, which outlines that revenue should be recognized when control of goods or services is transferred to the customer, rather than just when payment is received. For instance, in a shipping contract, revenue is recognized when the cargo reaches its destination, and not when payment is made. This differs from general accounting, where simpler transactions might not require such detailed consideration of performance obligations. Inventory valuation methods are crucial for determining the cost of goods not yet sold. In shipping, this typically includes fuel, onboard supplies, and other materials crucial for voyages. IAS 2, or Indian Accounting Standard 2, provides the framework, emphasizing consistent use of methods like FIFO, first in, first out, or the weighted average cost. For example, a company might use FIFO to value its fuel inventory, ensuring the oldest stock is accounted for first. This consistency is vital in shipping due to fluctuations in fuel prices, which can significantly affect profitability. Unlike general businesses, shipping must account for inventory held across different international locations and vessels. Fixed assets and depreciation concern the allocation of an asset's cost over its useful life, which is particularly significant in shipping due to high-value assets like ships. IAS 16, or Indian Accounting Standard 16, governs this area, ensuring that the financial statements reflect the gradual consumption of these assets. Shipping companies might use straight-line depreciation to evenly distribute the cost of a vessel over its operational lifespan. This accurately reflects the wear and tear on ships, thus impacting the company's financial health and decision-making. Unlike general industries, shipping assets have long lifespans and are subject to international maritime regulations, affecting their valuation. Lease accounting involves the recognition and measurement of leased assets and is crucial for shipping due to the common practice of chartering vessels. Under International Financial Reporting Standard 16, or Indian Accounting Standard 116, companies must recognize leased ships as right-of-use assets on their balance sheets, distinguishing between operating leases and finance leases. This means that a chartered ship might be recorded similarly to an owned asset, affecting financial ratios and balance sheet presentation. For example, a shipping company chartering a vessel for several years must account for it as if it were a purchased asset. This approach differs from other industries where leased assets might not involve such high capital values. Contract accounting and work in progress (WIP) are crucial for tracking costs and revenues in long-term contracts, such as those common in shipping involving multi-stage projects. Under International Financial Reporting Standards 15, or Indian Accounting Standard 115, revenue is recognized as performance obligations are met, often requiring progress measurement methods like cost-to-cost or milestone completion. For instance, a shipping contract divided into stages like loading, transit, and unloading will recognize revenue at each stage completion. This is more complex than most industries, where contracts might not extend over such lengthy periods with multiple deliverables. Provisions and contingencies relate to accounting for uncertain obligations and potential liabilities, which are particularly relevant to shipping due to risks like environmental damages from spills. IAS 37, or Indian Accounting Standard 37, directs that provisions should be recognized when an obligation is probable and its amount can be reliably estimated. For example, a shipping company may need to recognize a provision for possible fines or cleanup costs following an oil spill. This differs from many other industries where such environmental risks are less prevalent and less costly. Foreign currency transactions are critical in shipping, given the inherently international nature of the industry. IAS 21, or Indian Accounting Standard 21, dictates that transactions in foreign currencies should be converted using the spot exchange rate at the transaction date. This means a shipping company might book revenue from a European client in euros, but convert it to the functional currency at the spot rate. Unlike many domestic-focused industries, shipping frequently deals with currency risks and exchange fluctuations, making accurate currency conversion crucial for financial stability and integrity. Deferred revenue occurs when payments are received before services are rendered, a frequent scenario in shipping with advance freight payments. Under International Financial Reporting Standards 15, or Indian Accounting Standard 115, such revenues are recorded as a liability until the service, such as the completion of a shipping voyage, is performed. For instance, if a shipping company receives payment to transport goods, it recognizes this as deferred revenue until the shipment is delivered. This contrasts with many industries where services and payments more commonly align, reducing the prevalence of deferred revenue. Cost allocation is about distributing expenses across various departments or services, crucial in shipping to manage and control costs related to voyages. Although not governed by a specific accounting standard, companies adopt internal policies to ensure transparent and consistent cost allocation. For instance, a shipping company might allocate fuel costs based on the distance traveled by each vessel. This requires clear allocation bases such as mileage or time, ensuring that each voyage accurately reflects its share of the costs. Unlike more straightforward industries, shipping involves complex voyage calculations, necessitating detailed allocation methods. In this section, we will go through all the key concepts of journal entries in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. When Blue Ocean Shipping Services was incorporated, the founders contributed 10 lakhs as share capital. This transaction increases the company's bank account and recognizes the share capital, reflecting the ownership interest of the founders. Initial capital is crucial for business operations, providing the necessary funds to begin purchasing assets and covering startup expenses. Blue Ocean Shipping Services purchased shipping materials worth 2,000 rupees on credit, which increases its inventory. Recording this transaction under accounts payable indicates a future obligation to suppliers. This is vital for maintaining stock necessary for operations without immediate cash outflow, supporting cash flow management and operational efficiency. Acquiring a cargo ship for 50,000 rupees financed through a bank loan increases the company's long-term assets. This asset acquisition is crucial for expanding operational capacity. The corresponding bank loan entry reflects a long-term liability, highlighting the company's obligation to repay the borrowed funds, enabling asset expansion and potential revenue growth. Blue Ocean Shipping Services provided shipping services worth 7 lakh rupee, resulting in increased accounts receivable. This entry records earned revenue, vital for measuring business performance. Recognizing revenue improves financial credibility and reflects business growth, essential for attracting investors and demonstrating operational success. Receiving 6,50,000 rupees from customers reduces accounts receivable and boosts cash flow, crucial for liquidity management. This transaction reassures stakeholders of the company's ability to convert services into cash, a key indicator of financial health and operational efficiency. Paying 1,50,000 rupees to suppliers decreases accounts payable, reflecting the fulfillment of liabilities. This transaction ensures good supplier relationships and enhances creditworthiness, crucial for maintaining reliable supply chains and negotiating favorable terms in future transactions. Paying rupees 50,000 rupees as interest on the bank loan is an expense that affects net income. This transaction highlights the cost of borrowing, impacting financial performance. Tracking interest expenses is critical for assessing the cost of financing and ensuring the long-term sustainability of the company's capital structure. Recording 2,000 rupees as depreciation for the cargo ship reflects the allocation of the asset's cost over its useful life. This entry impacts the income statement by recognizing the wear and tear of assets, ensuring that the financial statements accurately represent asset value, crucial for long-term financial planning and investment analysis. Setting aside $1,000 rupees for income tax reflects the company's tax obligations based on its earnings. This provision ensures compliance with tax regulations and affects the company's cash management strategies. Accurate tax provisioning is critical for preventing penalties and maintaining financial integrity. Finalizing the financial statements involves closing temporary accounts to prepare for the new accounting period. This process involves transferring revenue and expense balances to an income summary account, determining net income. The closing entries ensure accuracy and readiness for a fresh start in the next financial cycle, providing a clear financial overview. In this section, we will go through all the key concepts of financial statement impact in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. In a shipping business like Blue Ocean Shipping Services, the balance sheet captures the financial health at a given point in time. Current assets such as accounts receivable rise with increased client shipments, reflecting future cash inflows. Prepaid insurance represents coverage for vessels. Meanwhile, non-current assets like vessels increase with new equipment acquisitions. Current liabilities, such as accounts payable, denote short-term obligations. Retained earnings grow as profits are reinvested, strengthening the company's equity and long-term stability. For Blue Ocean Shipping Services, the profit and loss statement reflects operational performance over time. Revenue surges from increased shipping activities credit shipping revenue accounts. Direct costs, including fuel and crew salaries, rise correspondingly, impacting gross profit. This gross profit is crucial as it indicates how efficiently direct expenses are managed relative to revenues. High gross profit suggests effective cost control and pricing strategies, providing vital insights into operational efficiency and competitiveness in the shipping industry. Indirect expenses in the shipping business, like administrative costs and depreciation, capture overheads not tied to individual voyages. These debits reduce net profitability, yet are essential for maintaining operations. EBITDA, excluding depreciation, offers a clearer view of operational cash flow. Profit before tax measures profitability pre-tax, reflecting operational success. Analyzing these metrics helps Blue Ocean Shipping Services identify efficiency improvements and cost-saving opportunities, essential for strategic financial planning and competitive positioning. Cash flow statements offer a real-time view of liquidity for Blue Ocean Shipping Services. Operating cash flow increases with revenue, underpinning business solvency. Investing activities, such as purchasing vessels, show long-term growth investments, though they reduce cash reserves. Financing activities, like debt repayment, signify reduced liabilities, but also demand careful cash management. Tracking these flows ensures the company can meet obligations, fund expansions, and seize market opportunities without liquidity constraints, vital in the capital-intensive shipping sector. Key ratios help analyze Blue Ocean Shipping Services' financial performance and strategic positioning. The current ratio assesses short-term liquidity, crucial for meeting immediate obligations. Debt-to-equity ratio indicates reliance on debt versus equity, informing leverage strategy. Return on assets, ROA, evaluates asset use efficiency, while return on equity highlights shareholder returns, guiding investment appeal. Operating margin reflects operational efficiency, which is vital in an industry where cost control impacts competitiveness and profitability. In this section, we'll explore frequent errors in shipping business accounting, focusing on mistakes that can affect financial accuracy and compliance. Understanding these errors is crucial for maintaining the integrity of financial statements in companies like Blue Ocean Shipping Services. Detecting and correcting these errors safeguards against audit issues and improves financial decision-making. Audit findings in shipping can reveal improper revenue recognition. This often occurs when revenue is recorded before services are rendered, violating accounting standards. For instance, booking shipping fees before a shipment is actually delivered. This error inflates revenues prematurely and affects profitability reports. Auditors detect such errors by reviewing contracts and service completion evidence, ensuring compliance with revenue recognition principles. Correcting this requires aligning revenue recording with the delivery of services, which maintains accurate financial reporting. Interview traps in accounting often arise when candidates overstate their proficiency with specific accounting software, such as ERP systems used by shipping companies. This can lead to performance issues if hired, as real-world tasks reveal gaps in skill. The root cause is usually a lack of direct experience, despite familiarity. To avoid this, candidates should honestly communicate their actual experience level and express eagerness to learn. Employers value honesty and the ability to quickly adapt to new systems, avoiding future operational disruptions. ERP implementation mistakes in shipping businesses like Blue Ocean Shipping Services can cause significant disruptions. These errors often occur due to insufficient staff training or improper system configuration, leading to inaccurate data entries. For example, if shipping costs are not correctly input, it can skew cost analyses and budgeting. These mistakes affect financial reporting, leading to flawed decision-making. Comprehensive training and thorough system testing before going live are essential to mitigate such errors. Regular audits can help identify misconfigurations early, ensuring accurate financial data processing. Cut-off errors in the shipping industry typically arise when transactions are recorded in the wrong accounting period. This often happens when the shipment date doesn't align with the recording date, such as logging sales in December for January deliveries. The financial impact is significant, as it misstates profits and losses for the period, affecting stakeholders' decision-making. Ensuring proper cutoff involves verifying transaction dates and aligning them with the correct financial period. Auditors will check shipping and receiving logs against accounting entries to detect such discrepancies. Standard switching errors occur when shipping companies fail to update their accounting practices to comply with new regulations or standards, such as switching from generally accepted accounting principles to international financial reporting standards. These errors often stem from inadequate communication and training within the organization. As a result, financial statements may not comply with current standards, risking penalties and loss of stakeholder trust. To avoid this, companies must ensure timely adoption of new standards, supported by comprehensive staff training. Auditors will focus on compliance checks to identify such lapses, ensuring financial accuracy and adherence to regulations. In this section, we will go through all the key concepts of interview questions in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Freight costs in the shipping industry are the expenses incurred to transport goods. These costs are typically recorded as cost of goods sold when they are directly attributable to shipped goods. For example, Blue Ocean Shipping Services would debit freight expense and credit cash or accounts payable. Recognizing these costs accurately is crucial for determining the true profitability of shipping operations, offering insights into cost management and pricing strategies. Under International Financial Reporting Standards 15, revenue is recognized when control of the service is transferred to the customer. For Blue Ocean Shipping Services, this means recognizing revenue as each shipping milestone is completed. For instance, when goods are loaded onto the vessel, a portion of the contract revenue is recognized. This approach ensures that revenue reflects the performance obligations fulfilled, thus providing a more accurate financial position and performance picture. Currency fluctuations affect international shipping profitability. Blue Ocean Shipping Services uses foreign currency transaction gains and losses accounts. If payment is received later at a different exchange rate, a gain or loss is recognized. For example, if a receivable in euros increases in value relative to the dollar, Blue Ocean credits a gain. Managing this ensures accurate reflection of financial performance and helps in strategic planning and risk management. The decision to lease or buy a cargo ship involves assessing financial implications. Under International Financial Reporting Standards 16, a lease results in recognizing a right-of-use asset and a lease liability. Buying involves capitalizing the ship as a fixed asset. Blue Ocean must compare the interest and depreciation costs of buying against lease expenses. This decision impacts cash flow, tax, and financial ratios, requiring careful consideration of strategic and financial goals. Fuel costs significantly impact shipping services' operating expenses. Fluctuations can lead to volatility in profit margins, affecting both the income statement and cash flow. For Blue Ocean, an increase in fuel costs increases cost of goods sold, reducing net income. Conversely, hedging strategies might stabilize costs by using derivatives, thereby affecting other comprehensive income. Managing fuel costs effectively ensures competitive pricing and financial sustainability in the shipping industry. Key SAP modules for Blue Ocean Shipping Services include SAP Materials Management for Inventory and Purchasing, SAP SD, Sales and Distribution for handling shipping orders, and SAP FI, Financial Accounting, for managing accounting functions. These modules enhance operational efficiency by streamlining processes, providing real-time data access, and facilitating compliance with accounting standards. Their integration ensures accurate financial reporting, inventory management, and customer satisfaction in the dynamic shipping industry. Under Indian accounting standard, dry dock costs are capitalized if they extend the life or increase the value of the asset. Blue Ocean capitalizes these costs as a separate component of the ship's asset value and depreciates them over the period until the next dry dock. This aligns expense recognition with revenue generation from the asset, providing a true reflection of its financial position and ensuring compliance with accounting principles. Under International Financial Reporting Standards 16, the distinction between capital and operating leases has changed, with most leases recognized as assets and liabilities. Previously, operating leases were off-balance sheet, impacting financial ratios. For Blue Ocean, a capital lease would involve recognizing a right-of-use asset and lease liability, while operating leases were expensed as incurred. This change reflects the economic reality of leasing, ensuring transparency and comparability in financial reporting. To record prepaid insurance, Blue Ocean debits the prepaid insurance account and credits cash or accounts payable. This entry reflects payment made for insurance coverage extending beyond the current accounting period. Over time, as the insurance is consumed, an adjusting entry is made to expense a portion, thus debiting insurance expense and crediting prepaid insurance. This ensures expenses are matched with income, adhering to the accrual accounting principle. Deferred tax liabilities arise when there's a taxable temporary difference between the book value and tax base of assets or liabilities. Blue Ocean recognizes them under Indian Accounting Standard 12. For example, if depreciation for tax purposes is accelerated compared to accounting depreciation, a deferred tax liability emerges. This liability reflects future tax payments, ensuring the financial statements accurately represent future cash flows and enabling effective tax planning and compliance. In the shipping industry, understanding the business model is crucial. Blue Ocean Shipping Services primarily earns from freight charges. Key costs include fuel and port fees, impacting profitability. Their process begins with booking shipments and ends with delivery. Compliance with regulations ensures smooth operations. Technology aids in efficient tracking and scheduling, essential for timely deliveries. Contracts with clients like manufacturers help maintain steady revenue streams. Accounting in shipping involves precise revenue recognition upon delivery. Allocating costs to specific shipments ensures financial accuracy. Key journal entries include debiting accounts receivable and crediting freight revenue. Depreciation impacts asset valuation over time. Fuel expenses are part of cost of goods sold, affecting profit margins. Foreign exchange rates are crucial in international dealings due to currency risk. Insurance expenses require careful tracking and allocation over the policy duration. When preparing for interviews in the shipping industry, focus on revenue recognition practices. Discuss strategies for managing variable costs like fuel. Showcase understanding of international regulations and compliance. Highlight the use of technology for improving logistics. Understand depreciation methods like straight line for ships. Demonstrate proficiency in handling foreign exchange risks. Finally, be prepared to discuss the financial implications of long-term client contracts, which provide steady revenue but may involve complex accounting. That is your complete guide to this topic. If this video helped you, please like and share it. It genuinely helps us keep creating content like this. Drop your topic requests in the comments below. Subscribe to Candy Mentor for more finance and accounting videos.